Growing money doesn't have to come with sleepless nights or big gambles. Some opportunities let resources expand steadily, with minimal risk and predictable results. The key lies in understanding which paths protect your capital while still offering growth, allowing beginners to build confidence and momentum without exposing themselves to unnecessary setbacks. Today, we will talk about best low-risk investments for beginners. So before we start, make sure to hit the like button and subscribe to my channel. 1. High-yield savings accounts. One of the simplest low-risk investments is a high-yield savings account, HYSA. Unlike traditional savings accounts, HYS, as offer higher interest rates, helping your money grow faster while remaining easily accessible. They are insured by the FDIC in the U.S., meaning your deposits up to $250,000 are protected against bank failure. HYSAs are ideal for beginners because they require minimal setup and involve virtually no risk. They are perfect for short-term savings goals, emergency funds, or holding cash before moving it into other investments. The key advantage is liquidity. You can access your funds without penalties, unlike certificates of deposit, CDs, or other locked-in investments. While returns aren't as high as stocks or real estate, the safety and ease of use make HYSAs a perfect first step for new investors. By regularly depositing funds and taking advantage of compound interest, even modest contributions grow steadily over time, building confidence and a financial cushion for future investment opportunities. 2. Certificates of deposit, CDs. Certificates of deposit, CDs, are another beginner-friendly low-risk option. A CD is a savings product offered by banks that pays a fixed interest rate over a predetermined period, such as 6 months, 1 year, or 5 years. CDs are insured, meaning your principal is safe, and they often offer higher interest rates than traditional savings accounts. The trade-off is reduced liquidity. Withdrawing funds early typically incurs penalties. CDs are ideal for investors who can set aside money for a fixed term and want predictable growth. Laddering CDS, where you invest in multiple CDS with staggered maturity dates, maximizes flexibility while maintaining consistent returns. This strategy allows you to access funds periodically while still earning higher interest rates. CDs are especially useful for risk-averse beginners who prioritize capital preservation over high returns. By combining CDs with other low-risk investments, you can build a diversified portfolio that balances safety, growth, and accessibility, forming a solid foundation for your investment journey. 3. U.S. Treasury securities. U.S. Treasury securities, including Treasury bills, notes, and bonds, are considered some of the safest investments globally. Backed by the U.S. government, they offer guaranteed returns and virtually no default risk. Treasury bills are short-term, maturing in less than a year, while notes and bonds have longer terms, often up to 30 years. These securities pay interest periodically or at maturity, providing predictable income. Beginners benefit from their stability, low risk, and liquidity, especially if investing through Treasury Direct or ETFs that hold treasuries. Treasury securities also offer tax advantages. Interest may be exempt from state and local taxes. For cautious investors, these government-backed investments act as a cornerstone of a diversified portfolio, balancing riskier assets like stocks. They are particularly useful for preserving capital while earning a return higher than traditional savings accounts, making them ideal for conservative beginners looking to enter the investment world safely. 4T. Series 1 Savings Bonds. Series 1 savings bonds are another low-risk option that protects against inflation. These bonds earn a fixed rate plus an inflation-adjusted rate, ensuring your money retains purchasing power even during rising prices. They are backed by the U.S. government, making them extremely safe, and can be purchased in small amounts, ideal for beginners. Interest compounds semi-annually, and taxes can be deferred until redemption. Series 1 bonds are not liquid for the first 12 months, and redeeming them before 5 years incurs a small penalty, so they are best for medium-term savings goals. For cautious investors, they provide a combination of safety, inflation protection, and modest returns. Investing in Series 1 bonds today allows beginners to earn more than traditional savings accounts while preserving capital, making it a strategic low-risk choice for long-term wealth growth. 5. Corporate bonds, investment grade. Investment-grade corporate bonds are loans made to financially stable companies that pay interest over a set period. Unlike stocks, they provide predictable income with lower risk, especially when issued by reputable companies with high credit ratings. These bonds are less volatile than stocks and can be held to maturity to secure principal repayment. Beginners benefit from the consistent interest payments, which can be reinvested to compound wealth over time. While corporate bonds carry slightly more risk than government securities, investment-grade options strike a balance between safety and higher returns. Laddering or diversifying bonds across multiple companies reduces risk further. By including investment-grade corporate bonds in a portfolio, new investors gain exposure to predictable income streams while keeping overall portfolio volatility low, providing both stability and moderate growth. 6. Money market accounts. Money market accounts, MMAs, combine features of savings and checking accounts. They offer higher interest rates than traditional savings accounts while providing limited check writing and debit access. MMAs are insured, low-risk, and highly liquid, making them suitable for emergency funds or short-term investment strategies. While returns are modest compared to stocks, they are far safer and provide flexibility. MMAs are ideal for beginners who want easy access to cash while earning a small return, bridging the gap between high-yield savings accounts and longer-term low-risk investments like CDs or bonds. Using as effectively allows you to store funds securely, maintain liquidity, and earn steady interest with minimal risk exposure. 7. Dividend-paying stocks, low risk. While stocks are generally riskier than bonds or savings accounts, certain blue-chip dividend-paying stocks provide relatively low-risk exposure with predictable income. Companies with a long history of stable dividends tend to be financially strong and less volatile than growth stocks. Reinvesting dividends through DRIP programs compounds wealth over time. For beginners, allocating a small portion of capital to dividend stocks balances growth potential with stability. Careful research is essential. Focus on established companies in essential industries with consistent earnings and dividend histories. Dividend-paying stocks act as a hybrid investment, offering income and potential appreciation while maintaining relatively low risk, making them suitable for cautious new investors seeking modest market exposure. 8. Low-risk ETFs and index funds. Exchange-traded funds, ETFs, and index funds can provide diversification with minimal risk. Funds that track broad market indices or bond indices reduce exposure to individual company failures. Low-cost ETFs allow beginners to invest in hundreds or thousands of securities simultaneously, lowering risk while still achieving market returns. Bond ETFs, treasury ETFs, or balanced funds are particularly suitable for risk-averse investors. Dollar-cost averaging, investing consistently over time, further mitigates risk, smoothing out market fluctuations. For beginners, ETFs and index funds are ideal for growing wealth safely while learning about investing dynamics without needing to pick individual stocks or bonds. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.